Good evening, everybody. Thank you so much for joining us on election night. We appreciate you guys taking some time to be here with us, Nursepreneurs. Let's get started with our Nursepreneur strategy, Conquer Real Estate. Today, we'll be talking about an introduction to real estate market fundamentals.
So Nancy, friend, I just want to let you know that information that we presented to you today is just for informational and educational purposes. Any prospective investor, we always encourage you guys to conduct your own due diligence, talk to your financial, legal, tax professional before you making any and every investment decision.
Pat, Nancy, and I were three nurses. We came together with one mission in mind. Our goal is to help fellow healthcare professionals alongside ourselves invest into real estate to go on a path to financial freedom.
Let's go over our agenda for tonight. We'll be talking about how you can understand key market fundamentals for real estate investing. You will also be able to learn some of the practical tools for market analysis that will help you make informed decisions, and you'll gain insights into risk assessments and mitigation strategies.
Let's do a little bit of recap on what is the real estate syndication. That's just gonna give a little bit background for some of you guys that never joined us in the past. So real estate syndication, the lay term is like regular people like you and I come together to invest in large multifamily or apartment complexes. That's two roles in real estate syndication. General partners or GP or active investor, just like Nancy, Fran, and I, who taking care of day-to-day operations, starting from, looking for the deals until managing the property, plan the exit strategies, all the legworks. That's general partner. Limited partner or LPs are on active, passive investor, just like you guys, who provide capital without, being a landlord, without doing the legworks. So why Nancy, Fran, and I love real estate syndication? Because we know that real estate syndication is perfect for BC healthcare professional, just like you guys, who want to earn an extra passive income without have to do the legwork, without have to get involved into the nitty-gritty of the property management, being a landlord, fixing the toilet. Providing capital and then get, return of investment back. So that's why we love the syndication, because it's very fit, with BC healthcare professional just like us.
So, why is it that we want you as a passive investor to understand market analysis? And that is because we want you to mitigate risk and maximize your return. By mitigating risk, you have to understand how to evaluate the market so that you understand the market and you reduce the risk. With maximizing your returns, you understand the market, and it allows you to understand that you're making the right investment decision. For busy healthcare professionals like us, we want to diversify our portfolio so that we can build generational wealth through different streams of income. And passive investing allows you to do that without taking an active role in real estate management.
Why does market fundamental matter? It helps us make informed decisions. We're able to choose investments that are in stable and growing markets. It helps us also predict our cash flow. Strong fundamentals will lead to consistent rental income. When we're in a good market, it also mitigates our risk, and it reduces the exposure to volatile markets and income loss. Having a good market fundamental will also help us with long-term growth. We're able to foresee, or project whether our property is going to appreciate and what the return potentials will be. And it will also help us strategize our exits. We need to make sure that we know what the market is doing so that we are able to sell a property at a profit. In the following slides, we will go more into detail over each key market fundamental.
Let's start with the first key market fundamental, which is supply and demand. So what is the supply? Supply is telling you, what availability of properties in that market. As you know that that supplies can be overly saturated or increased by, when you see new construction, you see like so many house and in foreclosures and like turnover. Excess supply could potentially lower property value and rental rate, which is different than opposite than the high demand. When you have more supplies than the demand, just like in Florida market, for example, in the past several months, there's so many houses that put on the market, which means that the value of your property, will be lower than, during COVID when there's not many houses on the market. When you have higher demand on the opposite, that could help increase property values and also can help increase the rental rates as well. The demand is driven by population growth, job growth, the income levels in that market, and also the location. If a desirable location, that's going to be higher demand. So why do we need to know supply and demand in our market? Because we know that when supply exceed the demand, that could potentially affect our return of investment. That's why it's important for us to focus on, this key fundamental before we make the decision to investing in that market.
We want to also understand economic indicators as a passive and active investor. We look into employment rates because with higher employment, it leads to a stronger demand for housing. We also look at gross domestic growth. With a growing economy, it's likely that our property value will also increase. Interest rates is also important because with lower interest rates, it makes it more affordable to get mortgages, to get financing. And with inflation, over time, the property value appreciates. High inflation may rise costs for investors and tenants as well.
We have to be able to do a demographic analysis when looking at our market fundamentals. You want to be able to know in your market what the population growth is. When you want to make sure that you're in a market that has a positive population growth year over year, don't just look at the last year or 2 years. You want to look at the trends anywhere from 5 to 10 years. You also want to pay attention to what the age and income levels are. If you have a market that has younger populations, for the most part, that will indicate that there's a higher demand for rentals. And your income levels would determine what the rent price can be for your potential property. You have to also know what the lifestyle preference is for that market. What are their needs? Do they need to be close to work? Do they need to be close to public transportation? Are there any nearby amenities as well? And you have to look at the migration patterns. Are people moving into that market or are people moving out of that market? And you have to understand why. Let's take, for example, California. People have been migrating out of California. That would be one of the things to keep an eye out and think, well, do I really want to invest in California if the people are leaving California? So whenever there's inward migration, we know that the economy is growing, meaning that the housing demand would be higher as well.
As a nursepreneur, we focusing on like closely is the neighborhood analysis. Like market and neighborhood analysis, we know that it's very crucial because neighborhood can influence rental demands and can influence your property values and can also influence your resident satisfaction as well. So before we look into any deal, we do a deep dive on the neighborhood analysis. We need to know the local neighborhood trends that help us predict the future demand and avoiding the area that may decline, so that preventing us from making a wrong investment decision. There's several key factors that we need to focus on when we look at the neighborhood analysis, is including accessibility, amenities, safety, and future developments. Accessibility is like, for example, if it's closer to the highway, is it closer to big jobs like market, we'll have to look at that too, because we have to take in consideration of the people that want to rent your property. Amenities, for example, is that property or neighborhood that you're looking for is, closer to any big parks, that one that shopping centers like schools, the good school rating also bring more good resident to rent your the property as well. Safety is number one concern. You don't want to be in the high crime rate area. So we really look closely into the crime rate in that specific neighborhood that we want to invest in. And future developments, if that community has any plan to expand projects that they want to improve that neighborhood, that's gonna help like attracting more people to move into that area, which is in increasing our rental demand. There's several tools that we can use when we do neighborhood or market analysis. For example, like Google Maps, Zillow, local government website. We're gonna go more into the tools in the following slides too that can be useful for you to look into when you do neighborhood analysis.
Part of our market research also includes a property specific factor. So we look at that specific property, we look at the age and any recent renovations to that property. How well maintained is this property? Sometimes we buy properties that are mismanaged, and we can go in and change the management team to increase the value of our property. We also look at occupancy rates, and a high occupancy rate shows that there's a strong demand and stable cash flow. If there's a low rate, that means that there could be potential issues, but that can also mean that there's room for opportunity to change that around. Rental rates are comparable to the rents in that area. If we buy a property that's mismanaged and the rents are below market value, we're able to add value to that property to increase the value of that property. And our value add plan, is put in place so that we can increase rents and increase our net operating income. And we can do that by adding parks and adding different amenities and adding any renovations that need to take place.
We also need to be aware of the real estate cycles. There's global events, political events that change and can disrupt real estate markets that can either create new opportunities in real estate or create higher risk as well. We need to be aware of these impacts so that we can adjust our investment strategy. Let's take, for example, COVID-19. The pandemic just sparked suburban housing demand while city property values decline. Us being able to recognize these shifts will help us identify good investment opportunities and avoid risks.
Like I mentioned in the previous slide, there's several tools that we can use and you can use as well as the passive investor when it comes to market analysis. The free tool like Zillow and Realtor.com that help you access the property listing, look at the historical price trends, and also neighborhood info. Apartment.com also one of another tool that you can look into when it comes to like detailed rental property listing, any data when it comes to rental and vacancy rates and amenities. CoStar report is one of our favorite report. It's not free though, you have to pay for, but for the CoStar report, it's very useful too, especially in multifamily investment. It's professional tool that provide you a detailed commercial real estate data, including the vacancy rate, any job growth, rent growth, and market forecast. So we love this CoStar too. Another free version of the tool that you can look into when it comes to neighborhood reports on crime rate and school quality and also housing trend is the Neighborhood Scout. You also can go to local government website as well to look at the zoning maps, infrastructure projects, and any property ownership records. So there's some of the example of the tools that as a passive investor, you can do your own due diligence and look into these tools when it comes to market analysis. And we always encourage our passive investor to do so.
With any real estate investing or investing in general, you have risk. And ways to assess that risk is We provided three here. Economic dependence. We want to make sure that the market that we go into is not dependent upon one market. For example, if we go into a little town and the entire town jobs are related to healthcare, and for example, that hospital, let's say, goes on strike and those nurses are no longer working. We don't want to depend on just one market in an area. We want to make sure that that area has job diversity. We also look into political stability and making sure that that market is landlord friendly so that there's policies in place to protect the landlord and investors, which would be us. We also look at natural disaster risk. For example, Florida just got hit with a big storm. So we try to stay away from areas that are known to have natural disasters reoccurring. For mitigating risk, we want to make sure that we diversify our portfolio and that we invest in markets that are stable and that we've done a thorough market analysis before investing in that area.
Now let's go over some of the red flags that you will find in your market research. When you're doing your market research for a specific market or neighborhood, if you notice or you see that there's stagnant or declining population, stay away from that market. Like we mentioned earlier, you want to be in markets that have a positive population growth year over year. A stagnant or declining population means that people are leaving that market. So then that will more than likely lead to high vacancy rates, which is another red flag to keep an eye out for in your market research. Any lack of job growth as well is a huge red flag. When there's poor neighborhood conditions, if there's a neighborhood that has high crime rates, the school ratings are not that great, or that neighborhood is always out on the news, you want to stay away from that specific neighborhood because you can always be in a good market, but a bad neighborhood. So your market research has to be, detailed to the neighborhood conditions. Over relying in a single employer, you want to stay away from what my husband always likes to say, one-man horse town, right? You don't want to just depend on one employer or one industry, because what happens when that employer, that industry decides to leave, or they're no longer producing the job demand. And another red flag to keep in mind is overbuilding in the area. If there's a lot of new development, a lot of construction, then there's going to be a lot of competition. There's definitely going to be a lot of oversupply, and that's again going to lead to high vacancy rates.
There's some common mistakes that we want our passive investor to avoid. For example, the one I've really commonly seen is some passive investor rely solely on an active investor's information. Remember, guys, trust but verify. So you have to do your own due diligence before you can also listening to that information. Also, you have to go and then look for information yourself as well. Ask for the report, ask them how they get that information, and then do your own due diligence. Another mistake that we want you to avoid is ignoring market fundamentals. Remember, Nancy, friend, I mentioned that market fundamentals is very crucial. So important to look at this, all the key factors, all the thing that the red flag, the thing that we have to look for, the thing that we need to be pay close attention to, so we don't end up making, you don't end up making the wrong investment decision. Another mistake that we want you to avoid is underestimating the risk. Remember, market trends change all the time. Always, think about what could be the worst case scenario. So you can be aware and preventing and reduce that risk, the potential risk that could happen. The strategies to reduce that risk and to avoid that mistake is to stay informed. Connect with your active investor, make sure you stay in touch, keep asking questions until you're really comfortable before you're investing in any deal. Also, like I mentioned, conduct thorough due diligence. Trust but verify. Do make sure you verify everything before you make any decision. Also, it's important to choose active investor with a strong track record in the market analysis. Um, Make sure that they share the same value as you before, so when you invest into the deal, you marry to the deal, you have to stay in the deal for many, many years. So make sure that they share the same value, make sure they have experience and can guide you to the right direction.
All right, so here we've put together a checklist for you as a passive investor to look for when doing a market research. You want to look at the population growth and its trend to make sure that it's a population that's increasing. You want to look at job market strength and the employment opportunities. Look for income levels and make sure that it's within range and affordable for the tenants. When looking at the location and neighborhoods, you want to look at major employers, transportation, amenities, what are the crime rates and school qualities in that area. You also want to know what the future infrastructure or any development projects that will be going on. When looking into the property condition and the value add potential, you want to know what the age and condition of that property is. What are the plans for renovation and improvement? You also want to know what is the potential for rents to increase. As the passive investor, you also want to know what the exit strategy is and how long will the property be held. You want to assess the market conditions and make sure that the future property has value. You also want to connect strongly with the active investors, as Pat said. Make sure that your values align with with the active investor, and you want to have communication with them constantly and make sure that it's transparent. Also, the team needs to have experience with handling similar deals, and that's a conversation that you should be comfortable having with that team.
Thank you, Fran and Pat. That was a lot of information. That's amazing. So let's go over our key takeaways for our webinar tonight. Mastering market fundamentals is key. It's very important that you have a basic understanding and that you're able to do at least at the minimum a basic market research. You don't want to end up in a deal that is in a bad market or in a bad neighborhood because it's your money. We work hard for our money. And I've met several investors, nursing investors that invest in a certain market. They did a quick market research and then their money is stuck there. The house that they purchased as a rental property is vacant. It's in a not good neighborhood and they're losing their money there. So you don't want to end up like that. So you want to make sure that you're able to understand the supply and the demand, what the economic trends are in that specific market, what the neighborhood dynamic is. That way it will lead you to making smarter investment decisions. Use research tools for insights. Use Zillow. I know CoStar is a paid subscription, but you can always ask your active investor to forward you to email you a CoStar report for a specific market, even for a specific property. There's government resources. You can go into the appraisal district. You can just pick up the phone, Google for a specific market if you're not in that market, and ask questions. There's nothing wrong with that. That way you have a picture of the market conditions and what the opportunities are there. And mitigate your risk to secure your investments. Identify risks like the economic reliance and the vacancies, those red flags that we talked about earlier. It's important for you to identify them early on so that you don't end up in a bad deal and you ensure that you are in a safe investment.
So in addition to our monthly webinar, us Nursepreneur also have a bi-weekly newsletter as well. The QR code in front of you, if you scan it, will send you to the newsletter register page. So you can get like our bi-weekly newsletter. We always encourage you to continue educating yourself until you get comfortable before you investing. Knowledge is the key. When you have like knowledge, you get more comfortable, and before you invest in any deal that you already have the head knowledge. You're ahead of the game. So join a nurse-led movement toward financial prosperity and freedom. Let's build this future together. Nancy, Fran, and I, we are nursepreneur. We walk in your shoes. We know your pain point. So let's transform our financial future together. Let's build a prosperity together. Sorry. So so thankful that you're here. We want you to continue learning. So hope that you will learn a lot from our bi-weekly newsletter as well.
And in addition to our bi-weekly newsletter, we also have one-on-one calls where we can chat. We want you to get on a call with us so that we can get together and see what your goals are and see how we can help each other achieve them. So if you pick your favorite nursepreneur and schedule a call, we're available to help you guys in any way possible. We want to thank you guys for joining us tonight.